everybody's assuming that quarter point hike's going to happen. I believe you also believe it's going to happen. But what are you expecting from Jay Powell's press conference?
If you hold cryptocurrency, be aware. The Federal Reserve meeting is today. And with the market already pricing in the almost certainty of another 25 basis point rate hike, the bigger question is what comes next, and will the Fed continue to raise rates until the economy breaks?
We have a long time before the next Fed meeting. The Fed doesn't make another decision until September 20th. And so we have 2 jobs reports, 2 big CPI reports, just a lot of data between now and then. So from their perspective, they have every reason to really sort of play this as sort of loose as they can, try and make sure they don't commit too hard to any individual path.
So here is where we stand. The Fed is set to raise interest rates to a 22-year high after their June pause. Fed expected to deliver another rate hike as inflation fight continues. The projected quarter percentage point hike would set the new federal funds rate between 5.25 and 5.5%. And let's be clear, looking at the latest CPI data, i.e. inflation data, the inflation rate is now down to 3%, off from near 9% almost a year ago, and close to the Fed's target rate of 2%.
What's interesting, and this will be an interesting case in behavioral finance or psychology that will get studied at business schools for years, right, which is the Fed has never wavered on their message, right, for the past 12 to 18 months. Powell has been resilient in saying, look, we are going to see this through until we get to 2 to 2.5%. Even if you assume inflation doesn't tick back higher, like we just talked about, 3 to 2, that last mile traveled is a really hard mile. You've got to tighten policy aggressively even from here to get us to 2, in our opinion, unless you drop into a recession, which would be disinflationary or deflationary. So we think the Fed probably does have more work to do. That's not priced into the market today, right? The market has to reset that, and that's going to probably create some volatility in the back half of the year. So here at mid-year, we'd kind of fade this big move in equities, this 16, 17%. You know, it's been all on multiple expansion, nothing on earnings growth, which has been well documented. So, you know, what multiple do you want to pay for the next dollar of earnings? Do you want to pay 21, 22, 23 times in a slowing growth environment? And an environment where policy is still tightening? I would be careful there.
And there is a difference between headline CPI at 3% and then core CPI. Core CPI is still quite a bit stickier, still at 4.8% inflation.
As you said, 3% is not 2%. 3% is where headline CPI is right now. I think the magic number for the Fed is 4.8%, which is where core CPI is right now. That number that strips out food and fuel, which are a little bit volatile. They're looking at that sort of more steady state inflation number, and it's quite a bit higher. So I think that's important.
So core CPI is the more important metric. And even just 3 weeks ago on stage, Jerome Powell said this.
I don't see us getting back to 2% this year or next year.
You don't?
No. I see us making progress, steady progress on, this is core inflation.
Yep.
Headline inflation is coming down now, it's lower than core. But for core inflation, I don't see us getting to 2% this year or next year. I see us getting there the year after.
2025?
Yeah.
Core inflation 2%. So you're going to be restrictive for a long time.
No, we will be restrictive as long as we need to be. But you know, if inflation is coming down sharply and we're confident that it's on a path to 2%, you know, that would be a different situation. You would begin to think about loosening policy. But we're a long way from that. That's not something we're thinking about now or in the near future.
Now, probably the most valuable video I want to share with you today is from veteran trader Gareth Soloway. But very quickly, some of you have been asking for an earnings update on sponsor of the channel XCAD. As you can see, this is the play area in the XCAD app, and we've been talking about XCAD for a while now. Highly recommend watch this video for an understanding on what XCAD is, linked down below. But just by watching YouTube videos, you earn crypto. Now the catch is, you do have to watch at least 80% of the video. We can see that my nerd has earned over 28,000 play tokens, right now valued at around $2,100. Again, just by watching 5 YouTube videos a day, at least 80% for the last few weeks. An update today is that XCAD now offers the ability to mint a legendary nerd, which is even more earnings, up to $150 a day. So every few days, let's check back in on this, and link down below if you want to download the XCAD app, start earning crypto. And finally, before Gareth, remember, the risk in all of this is not tomorrow's, today's 25 basis point rate hike. The bigger question is, if you hold cryptocurrency, should we expect a further recession if the Fed continues to tighten and inevitably break something?
So I think the risk here, and again, it's a risk, is that in the back half of the year, inflation could actually tick higher. It's not going back to 9%, but it could go from 3% back closer to 4%, which then has the Fed in a very different position. The Fed is not done in July then, and needs to do more work later this year.
And while in yesterday's video, we brought you the bullish narrative, Mike Novogratz explaining why we are in a bull market, but with inflation still high, and with the Fed still trying to engineer a soft landing, although they've never ever done that in history, it's always been a hard landing, Altcoin Daily will continue to bring you both sides of the Bitcoin so you have all the information so you can make the best decision for you. Well, veteran trader, friend of the channel, and founder of Verified Investing, Gareth Soloway, updates us on his reasoning why energy costs like oil, part of CPI, part of inflation, will keep inflation high, and thus why the Fed will push us to more pain.
All right, we're going to talk a little bit about CPI data and why everyone's telling you out there that it's going to continue to drop. I am here to break the news that it's actually going to start to go up. What does this mean? Well, it means inflation is going to start to rise again. This is going to make it very hard for the Fed to not only be dovish, they'll likely be more hawkish, but ultimately it's going to make it so they cannot cut interest rates. And that is going to be very critical when the economy starts to stutter later this year and potentially going into recession. Because remember, the playbook for the Fed is recession comes for the U.S. economy, they lower rates and print money. Well, that worked when inflation was under 2%. With 3% inflation and inflation now starting to uptick, almost impossible for them to do. So let's take a look at the chart. Here's inflation. Here's where food inflation is. Notice it's higher than regular inflation. Here's energy. Energy has dropped. This is as of the last CPI data. So energy collapsed over the last CPI data. And again, this is going back for the last year. So this is the kicker. If energy starts to rally, inflation is going to move up. Well, let's take a look at some charts. So let's go right in here. This is oil, guys. So check this out, right? So this is oil. Look at the run. In the last month, this is where the last CPI data came out. The last month, oil is up 10 to 15%. 10 to 15% just in 1 month. Think about what that's going to do for the month-over-month CPI. And then you go back towards a year ago, and we're getting close to the same levels, which means inflation is not going to continue to drop. Now let's take another chart here. I want to go back to my main viewer here. Let's look at this one. This is gasoline. Look at the run in gasoline, up 15 to 20% in the last month. Okay, 15 to 20% in the last month. And look at this, basically at 52-week highs. If you go back to June and July of last year, we were right here. We're basically right back to that. That is telling you inflation is going to move to the upside or at least stall here at 3%. Lastly, I've got to show you this, guys. We talk about food, right? Food being a key component. We saw inflation in food was still positive versus oil and energy was negative. Look at this. This is the DBA, which is an ETF that tracks agriculture. So wheat, corn, all of that stuff. It's at 52-week highs, up significantly in the last month. And again, year over year, we're at 52-week highs. So inflation is coming back. And this makes it almost impossible for the Fed to be dovish, let alone cut rates when the economy gets into issues. Everyone who's telling you that CPI, that consumer price index, is going back or inflation's going back 2% or sub in the near future is BSing you. CPI is going to be stagnant and sticky at 3%, and it likely will uptick a little bit in the next CPI report.
So in summation, with a slowing economy, at least with the Fed trying to slow the economy with these rate hikes as best they can, yet with inflation still sticking around, you tell me down in the comments if you're bullish like Mike Novogratz, like Michael Howell going into next year, or if, like some of the other experts, you're expecting a further recession. Comment down below. Like always, see you tomorrow.